Hello and welcome back to our channel Polo Vega. On today's video, we shall speak about rate of return. Before we commence with our video, we shall talk about the disclaimer / the disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the fifth of a series of interactive videos aimed at educating our viewers about various kinds of rates of return and the ways to distinguish between them. The agenda for today's discussion includes the following topics: rate of return, nominal rate of return, real rate of return, rate of inflation, and net rate of return. Rate of return on investment talks about the average loss or gain made on the investment over a certain period of time. Since it's a dynamic concept, one needs to specify the period of time over which the rate of return is calculated. It's usually expressed as a percentage with the average loss or gain as the numerator and the total investment as the denominator. One needs to be fully aware of the expected rate of return while investing into any kind of asset, be it stocks, bonds, real estate, precious metals, or any other form that commands a value in the market. Nominal rate of return. Nominal rate of return is the amount of money generated by an investment before factoring in the expenses like taxes, fees, and inflation. Although nominal rate of return does not give us the exact return from an investment, it acts as a tool for comparison of different kinds of investments, as it does not include taxes, which could be different for different investment vehicles. Consumer Price Index. Consumer Price Index measures the overall change in prices paid by consumers. It is a weighted average of prices of a basket of goods and services, representative of aggregate consumer spending over time. CPI, as it's called, is the most widely used measure of inflation or deflation. Rate of inflation. Inflation refers to the overall increase in consumer price index over a specific time period expressed as a percentage. Inflation rate, in other words, is the percentage at which currency is devalued during a time period. The rate at which the currency devalues is the rate at which the buying capacity of the currency goes down, and therefore the price of the consumer goods goes up by this rate. Real rate of return. The real rate of return is the actual rate of return after factoring in the rate of inflation. It is calculated by dividing 1 plus nominal rate of return by 1 plus rate of inflation and subtracting 1 from the quotient. This basically allows us to deflate the rate of return by the percentage at which a currency is devalued during a time period. We have not factored in the other expenses like taxes and fees, as they tend to vary with different instruments of investment, and the taxes are paid on the nominal rate of return obtained from the investment. In other words, if one does not discount the tax and fees from the nominal rate of return, then one may end up losing money even if the real rate of return is positive. Net rate of return. Net IRR, or internal rate of return, is used to measure the performance of an investment after factoring in fees and carried interest or compensation of the general partners. It is a rate at which the net present value of negative cash flows equals the net present value of positive cash flows. Net IRR is traditional IRR taken into account the effects of fees, costs, carried interest, and other deductions that IRR or internal rate of return would typically overlook. To summarize the discussion on various rates of return, one can conclude that nominal rate of return is basically used as a tool to compare the returns from various investment vehicles, while the real rate of return shows the actual return after considering inflation. The internal rate of return and the net internal rate of return helps the investor assess the viability of a project as accurately as possible while factoring in different interest rates, fees, costs, and expenses over the life of a project. Thank you, and we hope you enjoyed our short video presentation on different rates of return. There are others like risk-free rate of return and the market rate of return, which we shall discuss at a later stage. In our next presentation, we shall talk about different rates of interest, effects of increase in a rate of interest, yield and yield curves. If you liked our video presentation, please give us a thumbs up and subscribe to our channel by pressing the button underneath. Speak to you again on next video. Till then, keep saving, keep investing, and keep getting wealthy. You may also visit us at www.polarvega.com or connect with us on our Twitter handle @polar_vega.